The first half of the year has been, to put it mildly, quite volatile on Wall Street. Europe concerns have not gone away. Breaking it down with me and looking ahead to the second half, we have Lee Munson in sunny Albuquerque. Lee is not the son of Yankees catching great Thurman Munson, unfortunately. He is with Portfolio, the chief investment officer. And Josh Brown, the reformed broker, media superstar. We appreciate you taking the time out of your busy day. So let's talk about Europe first. Lee, I would love to get your perspective on where this finally ends. We have an endless series of summits where people discuss what needs to be done to rescue Europe. And nothing seems to work, mainly because Angela Merkel just keeps saying nein to just about every idea that the rest of Europe has.
Well, absolutely. I mean, Europe is, generally sort of like a pinko socialist zone. And it's very similar to how Occupy Wall Street runs their things. They have these big assemblies, they talk, they don't get anywhere. I think that what we need to remember as U.S. investors, what is the risk to our portfolios here? I don't care about some German pension fund. And the risk is we have German break-even spreads, the idea of what inflation could be, at about a 0.8. For those out there, that's really, really low. If Ben Bernanke had a 0.8 break-even spread in the U.S., he'd be doing QE 3, 4, and 5 altogether. So all we really care about here in the United States is not this endless stuff. They just take more time, guys, than we would do in America. It's that they keep liquidity very loose, keep printing money, and I think they'll muddle through it. If we start to tighten, I'm going to be concerned. I'm going to get nervous.
Do you agree with that? Well, I don't see tightening anytime in the near future with this Fed and with Mario Draghi running things at the ECB. But do you agree that it's that simple, or does Europe really need to figure something out a little bit more constructive? Because you could make the argument that Europe muddles along for a while. That hurts China. That in turn hurts Brazil. That obviously hurts the U.S.
The consensus is becoming something quite dark. People don't tend to take action until they have to. And a great example of that is Lehman Brothers, obviously. I don't know that we need a global catastrophe, but we probably need a lot more fear than there currently is.
I agree with Josh that in America we are looking for that shock because that's how we generally run things here in our country. But I have to say the U.S. investor needs to know that Europe in general, look at their structure, look at that socialist structure, how they run unions, how their culture is. I think that for them, there's not going to be any shock and awe over them.
Forget about the way they like to run things. At a certain point, this comes completely out of their hands. What does that mean for U.S. investors? It's not that Europe is a huge part of, let's say, S&P earnings. It's less than 20%, of trading with Europe. It's the thing that's keeping people from making plans, from ordering equipment, from hiring. It's the thing in the back of everyone's mind right now, believe it or not, in the U.S. So
but look at the U.S. Look at the U.S. So look at the Fear and Greed Index that CNN Money puts out.
Thank you very much.
Look at last August. The Fear and Greed Index has done nothing but go up over the past couple months, number one. Number two, the volatility of the United States stock market is 40% lower than it was a year ago when we had the last European blowup.
A fair point. To move things forward, because I think we've definitely talked a lot about Europe. The other, I think, big macro concern that many investors have is this so-called fiscal cliff. We've got a very important election in the U.S. this year. People wondering who's going to be the next president, what's going to happen with Congress. This probably all leads up to Congress doing squat until after the election. Does the Fed need to step in at some point?
The Fed is not going to prevent a catastrophe with QE3. QE3 is what's being held in reserve so that if the worst happens, whether it's a hard landing in China or a Europe blow up or fears of the fiscal cliff, they have that tool that they can then come in with. To do some kind of a huge bond buying program now probably doesn't solve any of those issues.
The individual investor out there wants to look at what could be some general signals that you can measure and look at where the Fed is going to be more likely to do QE3 than less likely to do. You want to look at something called the 5-year, U.S. Treasury break-even spread. And it basically says what traders think inflation is going to be in the future.
To wrap that up, I think any investor needs to realize that any more hints about what the Fed's going to do next probably have to wait until August when Bernanke speaks at the Jackson Hole symposium that the Kansas City Fed sponsors. I'm going to talk to the Fed, though, Lee, and see if they can move that from Jackson Hole to Albuquerque.